we'll go from there. So
And
thank
I'll monitor the chat for any questions.
Thank you. Thank you everyone for joining. This is, I think, our fourth or fifth month now of doing this, where we are presenting content and just sharing our experiences as we've been doing the RV park investing. Today we have Jay Holder who will be joining us. He's gonna hop in a little bit later because he's got some kid things that he's taking care of right now with activities after school and all the fun stuff that he does. Jay's joining us because he's expert in the stack method and he's been helping us on some deals. So as we talk about creative financing, there's many, many options to get into RV parks. So I have a slide deck, although that is not why we're here today to look at slides. We like this to be conversational. So you guys ask us questions. We'll share with you some deals that we've done, how we've structured them, deals that we've looked at and walked away, and why we've walked away. We'll talk about that. And then we'll talk about the different ways that we've gotten creative in this space. So I'm going to go ahead and share my screen.
And Eric, I'll add one more thing. Although we like to focus on RV parks and a lot of our creative deals are based on RV parks, you can take a lot of these creative strategies and go after anything, whether it's apartments, single family, businesses, you name it. So anything we're talking about here, you can transplant to any different asset class you're looking for.
Absolutely. Great, great call out there, Jason. Can you guys see my slideshow okay? Awesome. Cool. So when we're investing in RV parks, I'm sure you guys, I know some of you have real estate. It's not just about the cap rate or how you're purchasing into the deal. It's about the structure itself and does it cash flow and does it have a good future outlook? So the real question when we look into this is how are we protecting our equity and how are we getting into the deal? And we have many stories about this where we almost didn't close because of the terms, and we actually have deals we've walked away from because of the terms. So I'll give you an example. Jason, you can talk about Inez and how we almost didn't close because we found some findings during due diligence and we got really close on that. And I'll share an example of one where we have walked away a few times because the terms were not there.
Yeah, you want me to go ahead and start?
Yeah, go ahead and kick in that example, and we'll
Yeah,
talk about
so
it a few times.
so on the Iron Spring Riverfront RV Park, which we've had since March, during due diligence, of course, that's where you verify a lot of your underwriting, right? So we had the owner had very good 2023 numbers and had very good um, numbers for the first half of 2024. What we discovered during due diligence when he had closed out 2024, the second half of the year didn't come out as he expected when he did the pro forma of how he thought the rest of the year would end. It came in, I wouldn't say significantly lower, but low enough that we had to take a look at our current purchase price. And we were able to have a real conversation because it wasn't about feelings or gut or anything like that. It was about solving a math problem. So when we sat down with the seller and walked through the numbers and showed what the impact to us as owners and to investors, because we did raise for that asset, he saw that, oh yeah, okay, well, with the NOI coming in lower than expected, I see how it affected the numbers. So because of that, he was open to renegotiation, and then we ended up renegotiating, I think, $250,000 off the purchase price.
Right. Which was fine. It was in that conversation too, it was a discussion with the seller. We got interest rates on that seller finance portion at 4%. So he wanted to maintain that 4% interest rate, which meant that we negotiated price. And that's the push pull with these things. You can negotiate interest rate, you can negotiate terms, you can negotiate the purchase price. And in this case, we had to do a price reduction because of that finding. And thankfully, we were able to get him to move forward with that. And we ended up purchasing it for a little about 450,000 below listing when he started that process. Another one that we've been looking at, we've gone back and forth on a couple times. This is an instance where the seller is not interested in the creative financing structure and they're looking for a bank note. And the interesting piece about it is it's selling at the right cap rate, but the rate structure with banks today and how you would have to finance it, it won't cash flow after purchase. And so we're really close on the negotiations where the seller is hard set that he has to walk away with 5.7 million on it. Although at 5.5 million is where it starts getting the cash flow that you need to be able to acquire that park. So you can tell sometimes you're going to get close like that and you can try and get at it creatively, or you may be blocked because the seller's not there and you have to understand even in those traditional ones when to walk away.
And remember, ladies and gentlemen, we're just solving a math problem. So this isn't personal. We're not attacking them or their purchase price. We're just saying, look, I want to solve your problem. This is what the bank is saying. The bank is saying that it can't fund based on your current purchase price and your current NOI. So how do we solve the problem? So that's the mindset you got to go into with these. And I never attack a seller and their price. I just say, okay, now help me solve this.
Yeah. And so we'll share a little bit about what we're going through right now. We have a stack method that we're looking at, and here's the feedback that we get for financing and why it's a struggle for RV parks. This is a unique asset class in itself, and what we're finding is if you reach out to national banks, they're not necessarily susceptible to it because it's a lot of times they're in rural areas. It's unstable income. It's more transient hospitality. It's And when they look at it, they're looking at it from the perspective that if you were to foreclose on it, it's going to take them a long time to disposition it. So they don't want to take that risk with it. SBA is something we've been working through, and we have somebody else who will probably be joining this call that has been working through the SBA. They create red tape. There's things that you have to do, like they are recourse notes. You have to put all other, if your assets, your personal assets have to go up against the note to be able to be repossessed if you don't perform on it. The Everybody that's in on the deal. So if you have equity partners, they have to be in on the note as well. So there's some restrictions with that depending on the percentage of ownership that they have. Um, the appraisals can come in low, and then there's limited funding options in those rural locations, which means you have to start going to local banks and see what they mean. So with this, and those headwinds that we face in this space, it means without getting creative, sometimes these deals can't get over the line. And that's what happened on the park that we're under contract on, is that it needs to have a traditional funding foundation and a seller finance portion to be able to get it over the line because of location and because of how the banks are funding. And we're getting bank approvals, but bank approvals are coming through on the RV parks lower and lower. We're seeing them being funded at 40 to 60% versus what they used to be at 70 to 75%. And again, this is more towards the transient space, which we're in. If you have steady rents and you're leaning more towards the mobile park, that may be a different story in that space. So just sharing our experience there. So Jason, you love talking about this with sellers, and guys, please interrupt us with questions because you do this really well and I see you do this really well, is when we get the sellers to understand that they're going to get the value out of their park is because we're talking about the creative side of it and what it means to them. So you maybe want to share some examples of how you walked through that.
Yeah. So a lot of times when I go have a conversations with these, so and they are just conversations, right? I'm not pitching anything and I'm not negotiating anything. I'm just having a conversation and I'm playing part friend and part detective, right? Because I've got to get past the smoke screen and see what they really need. Tax deferral is a big one, right? So we know in big assets like this, you're potentially talking anywhere between one to a couple $1 million in capital gains. This isn't like selling your personal residence because we can offset, a married couple can offset the capital gains of selling a house. That's no big deal. But in the fact that you're buying an RV park, which is a business and a real estate asset, there's a lot of money on the line, and so tax deferral is a big one. Um, Next, when we talk about owner fatigue and retirement, they love the cash flow. They've been enjoying the cash flow of an RV park for years, but they don't want to own or operate it anymore. And they just don't want the responsibility. So if you're offering to still give them a check every single month for the next however many years, and they don't have to do any work but just cash that check, that usually becomes a really great selling point because they loved that monthly cash flow. They weren't such a fan of that work after all those years. I mean, people get into RV parks because they love it. The problem we're seeing is a lot of these mom and pop owners have just been manually running these parks and people like Eric and I, we come in and we streamline everything. We use software and we automate as much as possible. And, we hire a park manager that understands all the different aspects of hospitality management and reputation management. And so that makes our job as owner operators much easier. I use Inez Spring as an example. It was a husband and wife and their kids that ran this park year over year. And they just got to a point. I know the wife got to a point where she just said, I just don't want to do this anymore. I love this park. I love this area. I love all the people. I just can't do this anymore. But getting that monthly paycheck was very enticing for them. And so that's another reason why sellers like the idea of seller finances. They still have that cash flow with none of the responsibilities. Um, and like we said, banks are disliking this asset class more and more. We're noticing the further we're getting into it. I really think it's interesting that rural is the reason why they won't fund, but I think rural is a strategy. I think people like to escape. I think people like to go just far enough away so that they're out of, the big city, but not so far that they're in the middle of nowhere. But you're finding that a lot of these really good parks are near national parks or near areas like rivers and forests and mountains and trees and all that. And so banks are pulling that rural. And when they hear the word rural, all they say is, well, if you default, it's going to take us forever to sell it to somebody else. And my response is, I have no desire to put all this work, energy, money into it and default. So it's that fine line of understanding what we're capable of and what they're willing to fund.
Well,
You don't,
and there's uniqueness on the properties, right? Like we
yeah,
look at some that are RV park, mobile home park, and then other apartment rentals. We've looked at some that are short-term rentals, boutique hotels, and RV parks. It's all of that uniqueness to it, which is fun for us to get into, makes it challenging when they go to sell because it's difficult to evaluate all of those things under one umbrella.
yeah. And the last bullet's probably the most powerful one, right? So I ask them, what does your next stage in life look like, and what is that going to cost? Because they'll say, well, I need X amount down, or my wife and I need so much money per month so that we can live, because we're going to live off of this for the rest of our lives. So now you know which levers you can pull. Is down payment important? Is monthly payment important? Is the overall price of the asset important? Is interest rate important? You know, if interest rate is important, are you open to interest only? Or are you open to interest only for the first couple years? Or in the case of the one we have under contract now, is the seller was got a big enough down payment that he was okay not receiving a monthly payment for the first 24 months.
Yeah, so
Because
that's a really, let me just emphasize that point. So that's another way to get creative is we're under contract on a RV park that we do have zero payments to the seller for 2 years. So we negotiated that because that gives us the runway to be able to build the business and to get it cash flowing the way that we need it to. So that was an important deferment for us. And like Jason said, it just took that conversation with him to say, well, what do you really need to get by? And he said, I just need 600 grand over 2 year for the next 2 years and I'll be good. Easy.
yep,
Hey Jay, welcome. And the other thing about it too is listening to the pain points. We have another one that we'll be signing contract on next week, that we may be shopping out. And that one, the seller came to Jason and they're seller financing it. It's a great deal. It's beautiful. And the conversation was, I need to have, what was it? They had a set number. It was
they had they needed
$7,900 a month.
$7,300 a month so that the husband and wife can retire.
That's it.
So all we did was start tweaking the numbers, extending the terms, changing the interest rate, playing with the down payment until we got to 7,300 a month and the cash flow.
Yeah,
So again, if you listen, the sellers will tell you exactly what they need if you have a real conversation and you just sit back and let them talk.
exactly. And Jay, feel free to jump in here too, because you've been in on some of these conversations with us as well. And Jay is fabulous at looking at creative solutions and everything. Some of the things that we spot that are red flags, and you have to be aware of this, especially as you're going into these creative financing structures, because you have to pull out things that are going to stop your closing or be an issue once you get to closing. Having a clear title and having people like Jason or Jay on your team that are transaction coordinators that are looking at the back end of this is important. And you can talk about that because you guys just cleared title, I think, on our our two parks, but there's things that happen behind the scenes that will prevent the closing on that because there's liens and debts that are not being communicated, right?
Yeah,
Yes, for sure.
on assets like this, a lot of things we see is we see tax issues where taxes are behind, or water. I've seen water liens on properties because, there's a lot of water used in an RV park and they might have fallen behind on their payments. Sometimes there's judgments. The beauty about businesses is when people realize somebody has a business and they can put a lien against it, it sometimes becomes a target. So you really want to dig into the um, title commitment and the title report and really see what you're up against, if at all. In this particular case, we didn't find any issues with title, but in the past we have. Jay, I don't know if you want to add to that.
No, I mean that's what I was going to say because that's what we did on the one of our last parts. We found out going into it, we got the guy's number, but then we found out he also was doing a capital raise to pay off part of his debt that we weren't disclosed on, which could have been a problem for us once we got to the closing table. So, yeah, that was a big one to find out late in life or late in the process, not life, late in the
Yeah,
process.
that's true because we were right before we were going to exit due diligence. That's when we found out he was doing a capital raise, and he needed that capital raise to be able to walk away from the asset, and we had no idea. And if he didn't finish that raise, it could have hindered us in the closing process as well. And the other thing about this, guys, and things that we'll find is that look for the red flags, do the due diligence because due diligence, just because you get seller financing, it doesn't make that process easier. You have to hire the experts, do the inspections, do the environmental studies, all those things that you would normally do with a transaction because you're going to find things. And we have, I mean, we've found electrical that was failing and had to be ripped out of the entire park because it was installed by somebody who was on drugs. We've found code violations and things that are happening at the parks because it was built in old infrastructure and years ago when the codes didn't have that requirement and how to separate electrical panels and so on and so forth. It's little things like that or hidden maintenance items with which are going on that haven't been taken care of. And we see that often in these parks. Like Jason, we had that one in Oklahoma that was just a hot mess of deferred maintenance, right? Like
Yeah.
we didn't get the inspection process on it, but you have to do those things even though you're doing the seller financing because all of that can risk your capital and your protections. And especially when you're going into this, you don't want to get into this and find out you have a money pit if you guys all know Tom Hanks in that movie.
Well, more importantly, when in a seller finance, you're literally partnering with the seller. Their payment is contingent on your success. And if you're going in there and you're finding things for capital expenditures and for deferred maintenance that you didn't plan for in your underwriting, that's already derailed you and you're already set up for a failure. So that's when you sit down and you have a real conversation. Say, look, this is what we found. I don't know if you knew it or not, but here it is. How do we want to deal with this? Because we need to make sure that we're successful, and then we're also presenting the park to guests that they'll want to come back to.
Yeah. And then if there's disputes in that too, like you have to be prepared to solve them. I'm just because you're getting into a seller financing deal doesn't mean that it's going to go well because it is a partnership. So there's an example right now that I know of where somebody got into a seller financing deal and the seller is involving himself in the asset. So he's walking on the property. The property's going through the construction phase, so they're remodeling it. They're doing a couple upgrades on the property, and the seller's walking in there and getting involved with the construction crew on site. And now there's going to have to be a dispute because the seller that holds the note on that property is trying to say, oh, just give me back the property. And he's trying to sell it out from under the current owner, even though he has no rights to it. And she's trying to refinance the note and get out from under it because she doesn't want to deal with him anymore. So part of your due diligence is also vetting your sellers. And if you're getting any red flags during that process, when you're going through that due diligence about the seller's behaviors and how they're acting, this is a good time to really reflect on if you can be in that partnership for a long time.
And it truly is a partnership. And I'll tell you, because we got the opposite with Inez, where we have sellers who want us to be successful, and they're giving ideas, and they're
Mhm.
seeing things and saying, "Hey, you're doing great with this. Have you thought about that?" Without actually being intrusive or demanding. They just said, "We just love what you're doing. Have you thought about this?" And we go, "Oh yeah, we have," or "No, we haven't. We'll take another look at it." Or we have taken a look at it and we're going down this path, and here's why. And they go, "Oh, I completely understand. I totally get it." So
Yeah.
you can get the opposite too. You can get a seller that they stay out of your way, but because they want you to be successful, they'll help you with some ideas, and they'll even share some things they would have done to the asset if they were still on board, but they don't have it anymore, so they're just going to share their ideas.
Yeah. And I want to hear from Jay and Jason on this because it's win-win mindset. Yeah, because Cassandra said I had one discussing CapEx need and how to adjust, and they said beggars can't be choosers. Whoops, you don't have to buy it. That's true. It's so true. And let's be honest, creative is not loopholes. We see this a lot in the communities that we're in where people are going in and they're like, hey, I'll seller finance it, but I'm going to seller finance it to you at principal only. And I'm not going to make payments for the first 2 years, and it's really crappy on behalf of the seller, right? It's not good terms. It's good terms for the buyer, but not for the seller. And so every conversation that we're looking at, it's how do we build long-term trust in that and make sure that we're making good decisions for both the sellers and the buyers. And Jason and Jay, you've seen this as well, if you have any commentary there.
Yeah, I mean, you've got to make sure it's good overall. But the thing is like when you're buying it, trying to get the seller to sell you a property that 100% is beneficial to you can cause issues with the seller in general at later in life. So I've had that happen personally where we got a really good deal. We were doing everything right, but the sellers weren't happy because it was taking too long, which they were still 3 years from the balloon date. And so I ended up just giving them the property back with the least option tenant that's in the property. And so they can deal with that problem. I don't have to deal with it. And, it was just because they were just impatient, but you can have that with sellers. So the better you're making the deal for the seller, the better chance you won't have that happen. So
Yeah, and that's a great point, and that's why we always offer an exit strategy in the form of a balloon, right? So most investors or most sellers don't want to be the bank forever, and I totally respect that. I'd love them to be the bank until the end of the term, absolutely. But if you're going to give me a balloon, give me between 5 to 7 years, because it's going to take 2 years after we've improved the asset to at least start to stabilize and start collecting, additional revenue that we didn't have before. And then it's going to take us another couple of years to, find a buyer at this new NOI. And then we also like to put in a little bit of buffer in there that says, hey, if at the end of 5 years, I'd be happy to do a 5-year balloon. But at the end of 5 years, if it doesn't appraise at 80% of, the true value of what we owe you, we can get an automatic extension.
Mhm.
So that protects us knowing that, hey, yes, we'd love to get out of it when you ask, but at the end of the day, if it's not cost effective to get out of it, there's no reason to lose money on it. Please give us a little bit of wiggle room. And a lot of sellers are okay that because they're investors too, and they know how business works. Um,
Well, and it's not only that is we've even negotiated in with terms for them. So if we have to extend, we would pay a half a point or a point or something, right? It's it's not about um getting the best win for just us as the buyer. It's we are truly focused on what is the long-term strategy and trust that you're building between these sellers and making the deal work for them and our investors. And let's just say that too, because it is the investors that come in, is you have to put these protections in place for them as well. And one of the things we do as on our properties, and Jason and Jay are really good about this as transaction coordinators, is what happens when you don't perform as well. And that's really important to put that into the contract and the verbiage is that if you're not going to perform as the buyer to what is the exit for the seller. And then once you start having those conversations with them and you show that you have their safety in mind, they're more willing to go down these paths and get creative with you. And there's so many different ways to get creative. We're talking about seller finance because it's at the foundation of how we get creative. But it doesn't necessarily mean that's every way you can get creative. You can defer payments for 2 years. You can do hybrid stacks. We'll talk about that. You can you can do things as equity shares. instead of doing full payments or full notes. So there's just so many different ways to slice and dice a deal when you get into the creative space. We're going to look at just a couple that are common in our world, and subject to is, I know, something that we've done a couple times, and we did this on Inez, and Jason and Jay as TCs, you can talk about all this stuff that happens when you do a sub two note and the benefits of that.
Yeah, so
So
go ahead, Jay.
no, go ahead.
So one of the recommendations that Jay made on the Texas part is to buy it in a land trust and then make the sellers the beneficiary in the land trust, and at close of escrow sign all the rights over to the LLC for that trust. Now, why do we do that? We do that because when the deed changes and it shows that it went into a trust and the trust has the sellers listed on it, all the bank does, all the mortgage company does when they see that, they go, oh, okay, they just moved it over into a trust. People do that all the time. And so does it prevent the due on sale clause? Nothing 100% prevents the due on sale clause, but it gives you another layer of protection that just prevents that trigger. Another thing we do on top of that is we do what's called a due on sale clause addendum. And what that is we make the seller sign that. That's basically a step-by-step list of every action that has to happen if the mortgage company calls the mortgage due. Because there is a series of things that have to happen from the seller whose name is on the mortgage. And if it doesn't get done, then the mortgage company will try and collect all their money or they repossess.
It also allows you to go around transfer taxes. So instead of having to pay all that money for transferring the property to a new owner, which is transfer taxes in Texas are big, and Florida, they're just stupid. I just had a client who did a subject to, he didn't do it via land trust. He wanted to do it to his LLC and he paid like $24,000 in transfer taxes alone. So it was not good. Had he had done it in a land trust or at a revocable trust, asset trust, then he wouldn't have paid transfer taxes at all. Because everything again it's still at the closing still owned by the same person, so it didn't transfer owners. But that's the big one on doing that. And then the asset protection you get is, pretty decent. Here's another fun fact. You don't have to register an LLC in every state if you buy it in a trust because you're the beneficiary, you're not the owner. So the owner is the trust itself, which is automatically in the state, and you don't have to register that. So you don't have to put an LLC in that state because you can personally be the beneficiary, or your LLC, wherever it's at, the beneficiary. They're not the owner. They just get the benefits of having the property in the trust. So that's another good little nugget that people don't know. They're registered LLCs in every state they buy in, which doesn't make sense when you don't have to.
Yeah. You guys
Great
just
point.
touched on a cool little tidbit about the trust. And that was important for us as we did our deals too, because there's levels of protections that come with that, right?
Yep. Yeah. And what's really good about that is like when you do a normal LLC purchase of a sub two or seller finance or hybrid, if you do have to battle the due on sale, you have to go through the title and you have to retransfer the title, do all of that, just to eventually transfer it again. Whereas with a trust, you just reassign the beneficiary rights if they really care. But at the end of the day, the quote unquote, the mortgage company is not going to see that because you don't file that anywhere. You just give them the signed copy of them being the beneficiary up through closing. So,
Great
and if
point.
you're really And if you're really adventurous, you can self-close that and not do like a title search. I don't recommend that. That is not a recommendation that I'm telling you to do.
No,
I'm just saying
no,
if you really
don't
want to
do
save some
it.
money, you can do it. You can do all this yourself. But I do not recommend that because you might be taking on way more than you want. I promise.
So in the RV park space, how this plays out and how it played out for us is that there was a mortgage on a building on the property. And so whenever we go into a conversation with the seller, we'll ask them whatever notes are due. And in the commercial space, if it's a commercial type note, this language may not be as familiar with them. So expect that they're not gonna really understand the sub two side of it, and you'll have to explain it. They do more assumable, which is another way that you can do it, is assuming the debt, and that's more common in the commercial space. But because
But the way to get around that, Erica, is when I talk to brokers, the first thing I say is, I totally understand it's not assumable. If I do want to take over the debt, I'll take it over subject to the existing debt, but I want to talk about this piece instead. So I just floated out there and then I moved to something else.
Right.
Because then I planted the seed, because then they'll come back and say, well, what did you mean by subject to the existing debt? And now I've got their interest, right?
Then there's all the seller financing. So a lot of the parks that we're looking at, they can be free and clear because the owners haven't taken out debt on them. So setting up those conversations with them, like we talked about earlier, with all the benefits that they're going to get from a tax perspective, the savings, so on and so forth, and it gives them that passive income. Really interesting. Like we said, our note in Texas is at 4%. Our note in our other asset we have under contract is at 6%. Our note is on another one we negotiated is, I think it's 6.5%, somewhere in there. So we're still getting better than what bank rates are offering in terms of notes. And it's a lever that you can pull. So when you're doing that, you're reducing that interest rate over time compared to the lenders, and it's really incredible value to the park. And we've done that a few times, and it's really been beneficial for us. I think the one that we had that we walked away, we negotiated like 5%, something like that.
I think it was 5.5.
Yeah, 5.5. And then there's the stack method, and this is really powerful. And it's good on if you have an asset that's high price or a high value add. And this is the hybrid stack, and this is what Jay specializes in. So maybe he can explain this better than anybody.
Yeah, I mean, so this has been around for a long time. It's got multiple names, but essentially it's a preferred equity type stack. So you go in and if we'll use easy math, and this would never happen in an RV park, but if it's $100,000 park and your seller is willing to take, let's say, 50% down and those seller carry 50% for 5 years, no payments. Always try to negotiate no payments if you can. You would go in at that 100K mark, go to a bank and average what 60 to 70% LTV on parks. Anything better is awesome. So you'll get on 100,000, you'll get, let's call it 70 grand. You give the seller their 50 grand after the closing. At the closing, 50 grand goes back to you, and then you give the seller an equity position of roughly 9% in your company with all of the guarantees of paying them the what you would on a promissory note. So they still get a promissory note. They just don't get a lien. They get added into the LLC. Now they can put a UCC one lien against your LLC. Obviously, you need to, if you're doing an LLC route, you're going to have to start a new LLC for every one of these, but that's fine. That's just part of doing business. And these you can't do in a land trust because most DSCR lenders will not lend in a land trust. I found one that will, but they won't do it on RV parks. So, and you can do this with any type of loan. So this can be hard money lender. This could be DSCR. This could be SBA. SBA is a little harder, but you can do it. There's some few tricks you have to do for that one, but yeah. So essentially, it's how you can get in for zero out of your pocket. You can put some. Number one, I'm gonna say this: you can put some money in your pocket, but anybody who tells you you're making money when you close, that's false. That's a false pretense because one, you're taking on debt. Two, you're taking on interest-bearing debt. So you're not making money. You're gonna lose money in the long run on it, but you are putting liquid in your pocket for the next deal, the next deal. Then once you have 4 or 5 deals, you're never going to notice that percentage of loss, but you're not making money. I don't care what wholesaler puts out there that you're going to get paid when you close. You're not. You're just
Well,
assuming debt and leveraging debt.
and
Um,
and what we're doing for the one that we structured, right, it's reinvestment of that debt to
yeah,
do an expansion. So if you have deferred maintenance or things that
yeah,
need to be approved at the park, or you can do some kind of expansion, you can use those funds for that improve your revenue flow.
yeah. And that's where I was going. Yeah, and I always tell you, and I think I did this in another group. That money shouldn't be used to like go buy a car or anything like that. It should literally be used to put number one, put it for reserves, put a portion of it reserves because if you have a down month or a down year, like you still got to pay your bills. You still got debt service. Two, like Erica said, for us, and I recommend you do this. If you've got a value add, use those funds for the value add, which is what we plan to do with ours, adding some cool little nifty features for the area that we're buying this park in. So be smart with it. Again, once you get up to 10, 15 properties or RV parks, obviously you can change what you do with that money. But If it's your first 1 to 10, put it right back in the park or put it in the reserves and hold it.
I know this isn't quite on topic, but I wanted to give another reason why it's important to create a new LLC for an RV park is the why am I drawing a blank? The tax benefit of doing
The cost segregation.
Yeah.
segregation. Thank you. I was like at the tip of my tongue. That's one of the downsides about buying someone's LLC. If they've already done a cost seg, you're out. You can't do it if you buy their LLC when you buy the business. But if you're creating a new LLC, you buy in the park in the new LLC, then now you have the opportunity to go in and do a fresh cost segregation, which is very powerful in RV parks. And that's probably a whole different topic on a whole different Zoom.
I just like to share their 40 to 70% accelerated depreciation year one. They're
Yeah.
one of the highest depreciation assets that you can buy. Yeah, so a couple things that we do, key terms we've thrown out, interest only periods is just that you pay interest only. We also like to use principal only payments. So principal only is if you're, say you have a seller that's coming in and they have a high price on their RV park and they're not willing to negotiate down that price, and that price is so important to them, you can negotiate a principal only with them, which means they're getting 0% interest on that. And so all of your payments go to pay down that principal. And so that makes sense sometimes, and it can be a negotiation tactic because instead of giving them an interest rate, which means they earn interest over time, you're basically front loading all that interest that they would have earned in the principal. And then you still pay it down relatively the same amount that you would between a interest bearing note if you were to buy it at a lower rate. So sometimes what we find is that sellers get more comfortable with that principal only method if you're meeting their asking price, because that means that if you decide to cash out or refinance in a year, they're still making the profit that they would have expected off of it. So it can be another negotiation tactic.
And this is really important when you're doing it, when you're doing the preferred equity stack, if you're putting them in the LLC, because you don't get hit with that imputative tax, which is the IRS's automatic tax. If you do a lien position or a mortgage against the property, you have to pay an interest rate of some kind. So, and it's required by federal law. There's nothing you can do about it. People get it at 0% all the time. And I'm not saying you can't do that, but if you get caught, there can be some problems. So I like the preferred equity stack better because that's just me paying somebody for giving me some money. That's a loan. That's not tied to a mortgage or a note. So they can take 0% interest and the IRS doesn't hit you like that.
Yeah. And then a lot of times what's going to happen is they're going to want a balloon payment on it because they're not going to want to be in this position forever. So balloon means that you may amortize or do an amortization over 30, 40, 50, 100 years. You can do whatever you want on these things. So you can get as creative as you want to. I don't recommend doing 50, 100-year notes, guys, but it's possible. And the seller isn't going to want to be around. A lot of these times they're aged. They're not going to want to hold this for 30 years. And so we'll do a balloon period and we like to start that about 10 years and then we'll negotiate down. I wouldn't recommend anything less than 3 because you need about 3 years to stabilize this asset before you start going into refinance. And most banks will require 3 years of good records to give you a note.
And always negotiate a minimum LTV on the refinance. So if you can only get an LTV of 55 and that's not going to do the debt service, unless again you're cash flush because you've got a bunch of properties and you've got a bunch of money, I would put an automatic extension in there and you can set the max to what you need. If they want to, like, you can't do it forever. You can say 3 years max. So every year you try to refi. If it doesn't hit 75% LTV on the refi, then you extend for a year. After 3 years, pony up, sell it. You've got to do it. You got to fix it. And you honestly could sell it to yourself, and actually do the same method by selling it to yourself at the end of the day.
And so what makes these deal closable is however you're structuring it, however creative you want to get, whether you're doing the stack method, whether you're doing the seller financing, however you structure it with interest, principal, etc. Make sure it cash flows day one. Because if you're not cash flowing at day one, you're not going to be able to service that note. And that is the number one thing we look at every single time in these with, especially with the seller financing is, can we service the note? I just underwrote a property right before I came in here. The guy wants seller financing. He's totally fine with it. He wants 1.9 million on a property. It's worth 1.2. And even with his terms, and he's got good terms on the seller finance, it's negative cash flow. And it doesn't matter if I amortize that sucker out for 100 years because I'm doing interest only payments of very low interest rate at 4% and it still doesn't cash flow. So always, always, always make sure that you're sharing that, and that as you're going through these conversations with your seller, that you're really transparent with them. That's one thing that we do. And you guys, if it's not in writing, it doesn't happen. So whatever you need to have in terms of how are you going to exit? What are the terms? Like that loan to value is very important. What happens if you do extend? What happens if you default? All of that needs to be written in the literature, and all those risks need to have a mitigation strategy in that contract that you're signing, and that between the contract and between the promissory note or the, is there anything else I'm missing, Jason and Jay? It's the between the contract and the promissory note, right?
Yep.
Yep.
Yeah. And then the reality is most of these questions we go into, and we'll see a lot of these properties are on market and they're overpriced by a lot. And we'll go, hey, this looks like a really great park, and you're selling it to us based on a pro forma, and we agree with your pro forma, but in reality, it isn't fundable. And even if you sell or finance it, you still have to question whether it's fundable. Even if you stack method it, you still have to question whether it's fundable. So all those things come into play, and it always comes back to that day one cash flow. What are you getting out of it?
So Cassandra's asking, do you have a minimum target cash flow after debt service and expenses? I like
Yes.
I like to see a minimum of 100K. Erica, you?
Yeah, so it can be a range, but I like to see, well, it's a little bit different than, I like to see about 80K in the GP share after debt service and investors, Cassandra. So I'm a little bit different than Jason.
Oh
So
yeah, in the GP LP stack, that's a little bit different. You're absolutely right.
yeah, so if we have to bring in investors, I like to see the GP cash out about 80K a year. Because you think about it this way with these parks, and I know other people go between 8,900 to about 12K a month is what they're targeting. And the reason is we've said it time and again, this is not passive real estate. This is active real estate. So if you're coming in and you're getting a park, and I look at parks all day long and the cash flow is a few thousand a month or 1,000 a month, and it's very, very low, you have to ask if it's worth your time to put that amount of energy into it. Because what we're doing at our parks is, you have a manager, your manager is going to come in and they're going to make somewhere between 30 to 50K annually for a decent manager, depending on the park size. And you can get work campers and all those things. Their primary focus is guest services. And that's what you want them focusing on. You want them interacting with the guests. You want them focused on that. Somebody still needs to oversee this. It's much more than asset management. Asset management is still there. It's the strategy. How do you get it to cash flow, so on and so forth. But we have weekly meetings with our parks. We look at everything from the operations. We're constantly involved in it because we have to monitor all those little things every week and those KPIs to make sure that it's going the way that we think it's going, and then make adjustments. And because of that, it's very active income, and that's why we look for those higher levels. So
And let's face it too, Erica, you're running multiple business. You're running an RV park, you're running a store, you're running a laundromat. You're running a propane sales, so there's firewood, so there's all kinds of moving parts. It really truly is a business in every sense of the way.
yeah. So we got a couple examples that we real live negotiations that we'll talk about. So we got a seller finance deal that's going under contract, and the purchase price is 1.8 million, and we have a 6.9% with no balloon. I think they did just introduce a 10-year balloon because they had their lawyer look at it. But what this means for us in this space is that this park will cash flow 200K a year. That's not a month. 200K a year, year one. And the way that we set it up with the seller was really smooth. They're doing Jason, is it like we did a 30% down payment on this, I want to say?
Yeah, it wasn't very much. In fact, it was a specific down payment they were looking for because they wanted to pay off a debt.
Yeah, so they had a small debt that they needed to pay off, and the way that it was structured, it's really easy to transition. And um, the way that Jason goes in and talks to these guys, they can't wait to sell to us. They're so excited about this park. They send him pictures of what's going on at the park, and that's the kind of partnership you want. Those are the green flags that you're going to get when you're going into these deals.
Yeah, they're texting you new reviews. They're texting you pictures of the what they did over the weekend with the guests, and those are the kind of things you like to see because that's another thing that you want to make sure happens during due diligence is the business still being run while you're making the transition to the new buyer, and those are the kind of things that kind of make it worthwhile right there.
Yeah, so example number two is a stack method. So the purchase is about 2.3 million, bank note of 1.68, and seller financing at 1.1 at 6% interest. And then a capital raise for the expansion. And this one has been a little bit more of a challenge because it's that rural location from a banking standpoint. So a lot of lessons learned in that space. But this is a typical what you would see from a stack method is you're going to try and get your maximize your bank note on that stack method. So whatever your purchase price is, you're going to look to get somewhere between 60 to 75% of that finance from the bank. And then you're going to take on seller financing for X portion. And the combined two notes you can see here are 380K above what the purchase price is, and that's done intentionally so that'll cover the closing costs. It'll pay off. We're paying the broker fee and we're paying a wholesaling fee on this one. And then we'll have a little bit of left after for reserves and to start the expansion. And then we can do either a construction note or raise capital for that expansion.
It should also be noted too that in this kind of deal structure, you're going to have a transactional lender and you have to pay their fee as well
Yeah.
because they're the one who's going to put in the seller finance portion into escrow so that the bank sees the whole funds are there and then they give you the clear to close. And then when the title company closes on the second half of the transition, they give the money back to the transactional lender plus their fee, and then you get the delta of what's left.
Yeah.
So it's important we add that in there too, because that's a cost and it's got to be accounted for.
And that's why you work with people like Jay, who does this all day long and has partners that can help get these over the line. He's smiling. He knows it. And then another creative way was seller financing and subject to for the win. So on this one, we had an existing sub two note at 3.15% interest and then seller financing at 4%, and we raised equity of 1.65 million. So that interest rate spread and the low end is really helpful. How you stack on the construction loan over the bank note, seller note, and PML? You have to wait until post-close to do that, Cassandra. So for our example, we have structures that we're going to be putting on the park, and those structures come with financing. So we can reach out to the company that provides those structures and we can get financing on those structures, which will finance a good portion of the build out that we're looking to do. That alone will cover about 250K of the, if we do the full build out, about 450K in build out. So that's one way to do it, or you find a private money person, or you do a small raise like we've been working on to cover that as well, and then you give them equity share off of that. Yeah. But the important thing is that you do all those supplemental things to do the build out after the note closes. So that's a great question. Yeah, so common mistakes, I think we've hit on it a lot, the over leveraging. I don't know that we need to talk about that anymore. Reserves, please, on RV parks, make sure you have reserves.
And one more thing, if you're raising capital for an RV park, that should be the first thing you say coming out the gate to investors. We have reserves. We are putting money in place for the things we don't know so that we lower the risk of having to go back to you for more money.
And I would call it deferred maintenance and reserves. So the reserves to me are there to protect in case you have a down month and then you cover the expenses, but then you have deferred maintenance, which you need to account for as well. I like to look at it as a percentage ratio. So I do a low, medium, high type evaluation on the deferred maintenance. And if it's high deferred maintenance, I may reserve up to 12.5% of the purchase price, which if you're thinking about that, that can be well over $500,000 or $750,000 really easily on these assets because they're larger purchases. If it's low, I may only reserve or do deferred maintenance of 7%, and then it can be down towards 100 to a couple hundred K. Um, and we're seeing it. We had a contract out on a asset and looking at the deferred maintenance, and after you get the inspection, we found out the deferred maintenance was about 175K. And so you want to have that on hand to be able to address those things because some of those things are going to be safety issues that you need to do for your guests. And then again, the reserves are a smaller proportion. If you're doing multifamily, typically the recommendation is like 250 per location. Um, I've heard on RV parks people that use like a 15% of revenue that they put into the reserves. We've put in our operating agreements on our park that we have 25K in reserves always. So it just depends on the size of your park and what your strategy is to make sure that's covered.
And I will add, this is why going and walking the park during due diligence is key because no matter what Erica puts in there for a percentage in the underwriting, she's going to validate it and raise it or lower it based on the findings of walking the park and reading the inspection report. So, so you can be pleasantly surprised and go, oh, okay, well, there's not as much deferred maintenance as we thought. Or the opposite can happen. There's more than you think. And then it might be time to sit down with the seller and have a conversation or raise your budget or walk away.
Absolutely. And then property management costs. And guys, this is so important in this is one of the things before you even go into these deals is make sure you're accounting for a manager because I don't know about you, but I don't want to be on site managing these assets and dealing with the guests. That's not what we're here for. So make sure that that's in there. And then the insurance and tax projections. And we're seeing that insurance and taxes are coming in much, much higher. So insurance on the parks, even though we've had people come and offer, hey, you don't have to fully insure the property if we're going to seller finance it. No, we disagree with that. If we're going to have investors and we're going to have partners in on these deals, we fully insure it for the risk that is there. Because if something happens, a natural disaster, we're in a flood zone, you're in a hurricane area, so on and so forth, you need to protect your asset and the people's money that are invested in it. And that includes the banks um, and your private investors. So make sure that you're doing your diligence and getting your insurance quotes that are done. We've been using Levitt, they're really good. Covera is another one that does specifically the RV park space. I find that they're pretty competitive with each other, but they are expensive and they're more expensive than what you think. On a $2-ish million park, we're seeing insurance come in at 20K for full insurance on the property and the business. Make sure you have your tax projections in there too, and make sure you know that any transfer taxes and all those things. And then equity productions. I don't know, Jason, Jay, have you used any of these? I don't. I mean, the clauses that you used are the ones we talked about, but we haven't really yet run into equity holdbacks or collateralizing the JV.
I would probably use equity holdbacks if you haven't agreed to some of the findings in the inspection and you want to hold money back because you didn't get all the quotes yet for that particular fix, and you're just going to set some money aside until you get those quote backs and you can decide what money is going to be used for what. That's where I've seen holdbacks before. Jay, I don't know if you want to add to that.
No, I mean, I was going to say the same thing. I've been seeing it a lot, but I've seen it with what you just said, where it was holding money back to fix things that weren't either disclosed or were found during inspection.
There you go.
And collateralized JV structures, we've done that a few times with when you're buying it creatively. Like everything's about when you're buying it creative with that.
I mean, the biggest thing is don't skip all this stuff when you're buying creatively. It's easy to just get into the deal and be like, you can close, yay, it's great. But these are all the things that you want to make sure that you're doing. We already talked about due diligence and reserves. I can't express that enough. Hire a professional inspector, go with a commercial inspector, pay the money. It's going to cost you about $3,500 to get a good inspection done. Make sure that it's done and make sure that they know how to inspect septic if you're getting septic. If they don't know how to inspect the septic, hire a separate septic inspector, somebody that knows how to look at the lift stations and the alarming bells and all those things. It's going to be really important as you take over the asset, because the last thing you want to do is have a septic error and you're spending $20,000, $30,000, $50,000 to replace that septic system. They're expensive. And the permitting on them is not easy to get, and the approvals take a long time. Make sure you have your war chest, which is the reserves we talked about, and then CapEx gets funded separately. And just really the biggest reason that people want to and continue to offer us these seller financing deals and people in the community is because we're really transparent with it, and we set up the structure right away to begin with. And we even walk away from deals. If we can't get a win-win on both sides, we'll walk away and they'll come back and ask us to buy the asset. So with that, I mean, we can go into some live Q&A. So we're just not talking all the time. I could talk about this all day, but would love to answer your questions if you have any.
And if you have questions on Morby methods or stack methods, ask Jay now or forever hold your peace.
On the financing side, have you guys run into any like red tape? Or I guess I should ask, like on the local banks, especially like Texas, is there like any one specific you use or just more like specific to the park? And then
It,
are you oh, go ahead.
yeah, it's specific to the park. You want to be in the location of the park
Right on.
and start building those relationships now if you can, if you have a specific, do you have a specific buy area, Josh?
Um, no, just Texas as a whole, really. But
Okay.
yeah.
So
And then
what's going to happen in Texas, because I've done this before, is the bankers are going to be regional. Do you know where you're going to buy in Texas?
um, I'd like to be closer to like either Dallas or Austin, and then I like Waco. Um, but you know,
Yeah, check what the big banks are in the area. If you're in the Dallas, Austin area, you might want to look at Prosperity Bank. They're who we use for our deposits and our regular stuff. So they're pretty
okay.
wide over Texas. They might be able to help you. We have not used them. I had looked at banks on the Gulf Coast of Texas, and when it came down to it, it didn't work out. They weren't
Got-
communicating and so on and so forth. So you're going to have to hit a few of them to see what happens.
Yeah, right on. And then for someone that's, hasn't owned multifamily yet, they're still in the single family space, are the banks looking at that like, hey, you haven't even owned anything this big?
Yes.
So,
So they that's a great question, and thank you for bringing that up because it's really important. The lenders and SBA included are looking for experience in this asset class. So you
okay.
can hold single family and it won't matter unless you own over 10 units.
Okay. Now, are they looking to have that 10 unit for like over a year? Or is there a time period they're looking at for?
I haven't heard that yet,
Okay.
that that's a problem, and it honestly depends on the financial institution. We had one that came to us and said we had to have three assets in the asset class before they would even talk to us.
Wow.
So it's all going to depend on the bank. So you're going to have to make a lot of phone calls to different banks. I know
Okay.
somebody in the community that is right now working with Marcus and Millichap for financing on an RV park. And so far they're getting better terms than what we've seen with other banks. But to be determined on if it works or not, right? You have to go through the process to kind of.
Yeah, I heard Ingrid Hernandez talk about Marcus and Millichap,
Mhm.
and she really wouldn't give up the contact unless the park was over 2 million. And I didn't have a lead in mind yet, so I didn't really push for it. But yeah.
Yeah, I'll be getting that shortly and I'll see what they have to offer, but start with the local banks and see what they can do for you once you have an asset identified. Or
Cool.
if you narrow
Especially,
down.
sorry, especially community banks. So like if you can get like a what are they called? Credit union,
Mhm.
Yeah.
community, local, where their mission is to put money into the area. That'll help you with the ruralness of some of these RV parks, like Jason was talking about earlier.
Yeah. And if you don't have the experience yet, you have to find a sponsor or a key principal to be in your deal. So somebody who has done this and has the experience and has the revenue to back it and the reserves. And some of those banks also will require reserves based on your purchase price. So if you're like the one we talked to, it was you needed 3 assets of similar, and then you needed to have 150K in reserves ready to go in your
Wow.
personal bank accounts.
Okay.
So there are people that will sponsor, and you have to find those people and make relationships with them and see if they'll be part of your deal. Generally, they'll do it for a share of the park.
Yeah, which makes sense.
And Cassandra's asking if y'all willing to loan sponsor. I know Eric and I are not quite there yet,
We're not quite there yet, Cassandra.
but we will get enough assets and enough revenue that we can be a sponsor. So that is our next goal.
Yeah. We actually are looking to avoid those banks and do more of the seller financing.
Have you guys ever thought about like a fractional lend instead of bringing in the banks, bring in a
Yep,
private?
we're testing it right now
Okay,
for the construction that we have to do at the park, the
nice.
fractional raise. Um, Interesting enough, I'm just observing the fractional environment, and I don't know. I saw a park go up last week and it came down with no money raised. Raising money right now is a little bit challenging,
Yeah.
and so people are holding back investments just due to the economy. So
And let's face it, guys and gals, when you need money, it's too late. So if part of your plan for your business is raise capital, you got to be raising capital every single day. You got to be meeting people and building relationships, and you got to decide if you can go accredited or unaccredited. Because unaccredited investors, you have to have a relationship with them for a minimum of 30 days before you can even pitch them. So you've got to figure out what strategy you want to go after. So get out there, network, join networking groups, fly in first class. Those are your investors that sit in first class. Put yourself in rooms where you can meet people with big checks and then build those relationships because people will open their wallets to people they know. They'll open their checkbooks to people they want to do business with.
and that's a full-time job in itself. So if you're going to do that, you can partner with people that's all they do is raise capital. So find those people as well and you can make a partnership that way and see if they have investors that want to go into the RV park space.
Sweet.
This is a team sport, not a single event. I see Ian shaking his head. Yes, he understands.
Hey guys, great Zoom call today. Quick question, a couple actually.
Yeah.
Hi from New Zealand, everybody. I haven't met anybody else here. So, is there like an amenity that you must have in all your RV parks that people may not think about, but you just think it may not be a big deal to get it installed or whatever, but you think people really enjoy that particular feature? Is there something that you guys do?
Laundry is huge. If you don't have laundry, you have to have the laundry. And as an owner, we installed automated meters at our park, and it has been the best invention.
Okay.
Which means, so Ian, it's not an amenity as much for the guest as it is for the owners. So the meter automatically Wi-Fi signals the readout to the software system, and then our manager pushes a button and we can bill everybody within minutes. And our recovery on the electrical bill, because the electrical bill is the highest bill that you're going to have at an RV park, we've
Okay.
been able to recover, I hate to say it, I'll say since ownership, 85%, but we didn't install these meters until what, June, Jason? And
Yeah.
since June, we've been at a 98% recovery ratio on our electricity.
And I
That
will
sounds
tell you
great.
too, And the other issue too is it becomes us versus them, right? So you have somebody walk out and they manually meet the readers and the meters, and then you get pushback from the people staying there. I mean, they've got a rig with three AC units and they don't understand why their electric bill's so high. In Texas, you can't make money on electricity, so all we can do is charge back what they've used at the rate that they've used it. And so having these meters that are wireless allows them to log in and see what their electrical uses is in real time. So it's not us telling them they've used this much; they can see it for themselves.
Yeah.
Yeah, it takes the argument out of the equation,
Yeah.
doesn't it?
Yeah.
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 And second thing is, sorry, what were you going to say there, Erica?
Oh, I was going to say another amenity we look for is just water features. We like to be, because we're guest focused, so water is important to us.
Okay,
So
sweet.
so
Yeah.
pools, rivers, beaches, anything that have lakes, those are all attractions that people head
Sounds
towards.
good. And I'm just dipping my toe into the whole RV market, which I'm quite excited about. Um, do you guys like? Do people like? Do you do fixed term stays, or can people casual? Can they just turn up, or do you mix both? Does it depend on the location?
All can apply and it depends on location. So the park that I believe you're getting into is long term. So people aren't going to turn over as much. They make a contract and they stay for a season. The
Yeah,
that we get into, it has all of the above. So we have people that come in from month to month. So they'll stay for
okay,
those longer periods of times and they may stay for 3 to 6 months at a time. We also get people that drive by on the highway and they just need to pull in for the night. And then we
right.
also get the weekenders that come in and they're just there from Thursday through Sunday.
Okay, sounds good.
Well,
Thank you.
and Ian, the reason why that's powerful is you've got dynamic pricing. Single night is different than weekly, which is different than monthly. And so
Yeah,
think about an apartment. That apartment has one monthly fee, whereas you have a pad has three different prices depending on what guest is staying on that pad. And because of that, we can have our premium pads with the best views, best location be transient only, so that our transients can get access to
yeah,
some of the best sites.
yeah, and pay top dollar for it as well. Yeah,
Yep.
it's good.
Yeah.
Good
And
stuff. Thank you.
you're welcome. Great question.
So how many of you, ladies and gentlemen, want to be owner operators versus being owners? I assume because it's quiet, there's not too many people that want to be owner operators.
Definitely owner. It's going to be harder for me to be an operator from here.
No, and that's great. And the only reason why I'm saying that is Eric and I are really going into 2026 with a different mindset. Our superpower is operations, and so we're going to start looking to either step in and help people in operations by either taking over the operations part of the business or provide a consulting service so we can consult on how you can become your own operator. Because that's one of the things that people have the biggest struggle with because they're not just walking into an apartment complex, which is just a rental asset that a property manager just same job day in, day out. You're running an ice machine business, a laundry business, a camp store, a reservation business, firewood business, reputation management business, propane, you name it. You're running all those different revenue streams and keeping everything coordinated. And for some people, they love it. It's great. It's like project management. No 2 days are alike. But for other people, they bought a business, they want to cash the check, and they want to move on to their next acquisition. So I just wanted to put that out there. That's going to be Erica's and I focus for 26 is helping those of you out there that want to be owner operators or helping you guys that don't want anything to do with RV park operations and be able to provide a solution for you. So definitely keep that in mind as you're going after these assets, what you want to do with the business once you acquire it.
Yeah. And that's one of the biggest things that we do share is that be cognizant of what you guys are getting into because if you're buying an RV park, it like we said, it is active income. So you do have to have some involvement, which you can do remotely, Ian, and you're going to be fine because you have people here that have been through it and boots on the ground. It's when Jason and I took over our park, we spent 4 months in the park and we were working from sunup to sundown in the park, just doing the stabilization. So I will tell you, as a W-2 job and running the park, it was very, very difficult for me to be in that space and be able to do both successfully. So it's something to consider if you're transitioning from a W-2 job into this asset class, that you definitely want to make sure that the cash flow is going to be there if you plan on exiting your W-2 job. Also know you are going to have a stabilization period where you're going to have a lot of demands on you. So look for people in the community again that can help you with that transition, and we're happy to help and consult if you guys need it.
And let's be clear, the reason why you don't normally have to be on site for that long, but we were also overseeing the construction. So we were building a shower and laundry facility. We were building 22, 23 more pads. We were switching over booking systems. That was Erica could tell you stories about that all day, every day. That was what she was focusing on. And we were building out a camp store, and we were redecorating a barn dominium on the property to be an Airbnb that sleeps 11. And so all that work that goes into it, you have to be, on site to manage that, or hire a project manager to do that for you. So the reason why I'm telling you this is, just because you buy an RV park doesn't mean you have to go live there for a certain amount of time. You just have to decide what your level of interaction with that asset is, and then what you're willing to outsource.
Well, thank you guys for coming to our event. We will publish this on our YouTube page if you want to watch it later. Look for our next event, and we may skip December. We'll have to decide yet because we're going to be closing and shifting some things around, and we'll start up again after the new year for sure.
Do we know what the topic is yet, or is this a surprise?
It's a surprise. I gotta go look. I have a
Appreciate it.
plan. I just have to go look for it again. So appreciate you guys. If you want to connect with us, definitely look us up on the social, or some of you already have been in our messages and have our contact info, and we're happy to set up time one-on-one if you have questions. So we're going to close out the line. I know that Kinet wanted to stay on the line, so if you don't mind us hanging out while we close off this recording.